Let's be real. Trying to predict cryptocurrency prices feels impossible, right? It seems like you have to be some kind of Wall Street wizard or a billion-dollar hedge fund to even have a shot. That's exactly what I thought. So I put it to the test. For the last 3 months, I've been building and testing the exact AI methods that big funds use to get an edge. I threw AI at Bitcoin, Ethereum, and mountains of data to see if it could actually predict crypto's next move, and I stumbled onto one signal that kept showing up before the price even budged. The results of this whole experiment were not what I expected at all. This journey showed me how AI can spot these invisible patterns and shifts in market mood that most traders, including me, completely miss. In this video, I'm pulling back the curtain to show you how it works, what I discovered, and how you can start thinking like a billion-dollar fund, even if you're just starting out. And trust me, it's not about finding a magic crystal ball. It's about something much more powerful. Honestly, most people go about predicting crypto prices all wrong. They stare at charts, draw a bunch of lines, and cross their fingers. That's called technical analysis. And while it has its uses, it's like trying to drive a car by only looking in the rearview mirror. You're only seeing where the price has been, not where it's going. Hedge funds get this. They're not just staring at charts, they're analyzing massive, complex sets of data that tell a much bigger story. They use AI to process information that no single human possibly could, giving them a serious edge. So my experiment was simple. Could I copy that on a smaller scale? Could I build an AI that thinks like a hedge fund? The whole experiment broke down into 3 phases. First, I'd start with the basics, an AI that only looks at price. Simple enough. Second, I'd bring in the secret weapon that many institutions are leaning on, market sentiment. And finally, I'd combine them, just like the pros do, to see if I could create a model that was actually predictive. First up, building a standard price prediction model for Bitcoin. The idea is pretty straightforward. I fed an AI model years of historical Bitcoin price data. Every single peak, trough, nauseating dip, and thrilling rally. The goal was to teach the AI to recognize patterns in the chaos. Think of it like teaching a computer to identify a cat by showing it thousands of cat pictures. In my case, I was showing it thousands of chart patterns that historically led to either a pump or a dump. For this, I used a common type of machine learning model called an LSTM, which is really good at understanding sequences of data over time. After training it, I set it loose on new data to see if it could call the next moves. And the results? Well, they were fine. Just okay. The AI was actually pretty good at identifying the general direction of a trend. When the market was clearly bullish or bearish, it did a decent job of following along. In my tests, it even learned patterns that correlated with classic formations like head and shoulders or double bottoms, often spotting the statistical shift faster than I could. But it had a massive blind spot. It was totally lost during choppy, sideways markets, and it was always late to the party on those sudden, explosive moves. It just confirmed my suspicion. Price data alone isn't enough. It's reactive. The model was basically telling me what was already happening. To really predict the future, you need to know why the price is moving. And that's what led me to the most fascinating part of this whole thing. Okay, this is where it gets really interesting. Hedge funds and big trading firms don't just analyze price, they analyze people. According to a recent survey from Coalition Greenwich, many quantitative trading firms now use sentiment analysis as a key part of their strategy. Why? Because crypto markets, more than almost any other market, run on emotion. Fear, greed, hype, and doubt. What if you could actually measure that emotion? That's exactly what sentiment analysis does. It uses AI to scan millions of data points from social media, news headlines, and forums to get a read on the market's mood. Is the chatter around Bitcoin positive? Is there a subtle, growing feeling of fear? This data often acts as a leading indicator, a signal that shows up before the price itself moves. So, I built a second model. This one didn't look at charts at all. Instead, it drank from a fire hose of crypto-related sentiment from all over the internet. I trained it to tell the difference between bullish hype, bearish FUD, and just neutral noise, and to flag when things felt off. And this is when I had my first aha moment. On a few separate occasions during my test, the sentiment model spotted a huge coordinated spike in positive chatter hours before a big Bitcoin price pump. The crowd was getting excited before the price had even started to move. On the flip side, it also flagged a rising tide of fear right before a sharp 10% correction. It wasn't perfect, but it felt like I was getting a sneak peek at the market's next move. This was the predictive signal I was hunting for. But it's only half the story. The real magic isn't in using one or the other. It's in combining them. If you're finding this breakdown of AI and sentiment useful, and you want to see more experiments like this one, do me a quick favor and hit that subscribe button. We're about to get to the core of the hedge fund method, and you're not going to want to miss how it all comes together. No single approach is foolproof. The most successful trading frameworks always combine multiple independent sources of information. That's the core philosophy of institutional trading. So, for the final phase of my experiment, I bolted the two models together. This new hybrid AI was now getting data from both my price model and my sentiment model. It could see the chart patterns and understand the emotional story behind them. For example, if the price model saw a bullish pattern forming, but the sentiment model was picking up on rising fear, the system would flag it as a low-probability, high-risk trade. It could be a bull trap. But what if that same bullish pattern was backed up by a surge of real positive sentiment? Now that is a high-conviction signal. Instead of giving me a single concrete "the price will be X" prediction, which is what everyone wants but is ultimately a fantasy, this AI works with probabilities. It generates scenarios. For instance, it might say, given the current price structure and a 75% positive sentiment score, there's an 80% probability of a 5 to 7% price increase in the next 24 hours. But there's also a 20% chance of a sharp rejection at this resistance level. For me, this changed everything. You're no longer just guessing. You're thinking in terms of risk and probability, just like a professional. You stop looking for a crystal ball and start looking for an edge. You identify high-probability setups and manage your risk against the low-probability outcomes. This is the single biggest mindset shift that separates retail traders from the big funds. To really stress test this hybrid model, I didn't stop at Bitcoin. I pointed it at Ethereum, and the results were even more interesting. Ethereum's ecosystem is way more complex, with things like DeFi, NFTs, and all the Layer 2s creating a much richer data environment. The model was actually able to pick up on shifts in developer activity and sentiment around major events, like the Denkun upgrade, which lined up with price movements. But this led me to the final frontier of crypto data, on-chain data. This is information pulled directly from the blockchain itself. Transaction volumes, the number of active wallets, and most importantly, the movement of money between giant whale wallets and exchanges. Imagine being able to see, in real time, that large holders are moving their coins off of exchanges into private wallets. That usually signals an intent to hold, which reduces the sellable supply and puts upward pressure on the price. On the other hand, a huge flow of coins onto exchanges can be a warning sign for a big sell-off. Integrating this on-chain analysis is the next level. Specialized crypto funds and analytics platforms like Nansen and Glassnode do exactly this. They combine price, sentiment, and on-chain data to create a three-dimensional view of the market. While building a full-fledged on-chain model was beyond the scope of my 3-month project, it proved the main principle. The more high-quality, independent data you can layer together, the clearer your picture of the market becomes. After months of building, testing, and tweaking, I came to the most important conclusion of this entire project. The true power of using AI in crypto isn't about being right 100% of the time. That's a pipe dream. The market is chaotic, and black swan events will always be there to humble you. The real secret is that AI is the ultimate tool for risk management. As human traders, we are an emotional mess. We FOMO in when the market is pumping and panic sell during a dip. An AI has no emotions. It doesn't get greedy. It doesn't get scared. It just looks at the data and reports the probabilities. By framing every trade in terms of scenarios, 80% chance of this, 20% chance of that, it forces you to be a better risk manager. It helps you avoid making dumb, gut-based bets. It filters out the noise, the hype, and the drama, and lets you make decisions based on data. This is how hedge funds survive and thrive. They're not trying to win every trade. They're trying to build a system where, over the long run, their wins are bigger than their losses. And that is a game of probability, not prediction. And of course, the mandatory disclaimer: nothing in this video is financial advice. This was all an educational experiment. Always do your own research. So, can you predict cryptocurrency prices like a hedge fund? The answer is yes, but probably not in the way you were thinking. It's not about having some magical black box that tells you the future. It's about completely changing your approach. First, you have to look beyond the price chart. Second, you have to accept that market sentiment is a powerful, predictive force that you can actually measure. Third, the real edge comes from combining multiple data sources, price, sentiment, and on-chain data, to build a complete picture. And finally, the ultimate goal isn't to be right all the time. It's to use these tools to manage your risk, think in probabilities, and make decisions free from emotion. This experiment started as a quest to see if an AI could beat the market, but it ended up giving me a much deeper understanding of what it means to be a disciplined, data-driven investor. The future of trading isn't about human versus machine. It's about a human empowered by a machine. If you enjoyed this little journey into the world of AI and crypto, please subscribe and turn on notifications. I'm already cooking up my next experiment and you won't want to miss it. Thanks for watching.